Yeah. A very, very warm welcome to MBMG's balloon debate today, reasons to be fearful or cheerful. I'm sure that looking at the two speakers we've got today, you know which one's which, but we'll do the intros in just a second. It's been a while since we've been to the Foreign Correspondents Club, so thank you very much for having us back. It's a pleasure to be here and to present again. Before I introduce the two speakers, we've got a big jar of Smarties going around somewhere. I think Kun Nam and Kun Gao are going around with a jar of Smarties, so if you haven't already, try and guess how many are in there, and you can win that jar of Smarties, and Paul Gambles will explain the relevance of that a little bit later on. Just to introduce our two speakers, it's as I say, it's a bull and bear debate today. The perma-bear of Bangkok is Mr. Paul Gambles. He's our Chief Investment Officer and a regular guest speaker on CNBC, CNN, the Money Channel. So Paul's going to be giving his views on the world. I hope this is being recorded because I can quote Paul saying just before this presentation that he's ready to be bullish, but I'll believe that when I see it. So we'll see what he's got to say today. A big warm welcome back to Joanne Baynham from MitonOptimal. It's been, I think you said it was 2006 last time you were here. So thank you very much for coming back. For those of you who know us, you know that we've been working very closely with MitonOptimal since about 1997. They provide a lot of our analytical advice, and I think over the last 5 years we've been much more focused on capital preservation rather than appreciation because of all the risks that are out there. But MitonOptimal provide a wide spectrum of investment options, and I think we're just looking, we've invited Joe today to come and tell us about some of the more aggressive is perhaps the wrong word, but some of those options out there that are looking to capture more appreciation as opposed to preservation. As usual, there'll be a question-and-answer session at the end of the debate. There's a microphone just in the middle at the top of the steps there, so if you do ask a question, please just state the name and your company, and then field that to the two guys that are presenting. So without further ado, I'll hand over to Paul Gambles. Thank you very much.
I feel a little bit less as if I'm separated from the room. I suppose what I want to say today is that this is not a real recovery that we're experiencing right now. The crisis of the last 5 years can basically be divided into two parts. We'd had one of the biggest run-ups in asset values. We'd had a huge bubble in most Western economies. Does it not work? Do I have to? Okay, all right, I'll move back behind the podium. We'd experienced, as I say, a huge run-up in asset values, and that was followed by the inevitable bust. And obviously 2007, 2008 was by all measures a pretty significant correction, which is what you'd expect following the scale of the asset bubble that preceded it. However, what we haven't seen is that the normal pattern of a recession is that it clears out a lot of the problems, it reduces debt, and normally we return to a situation where we get reasonably strong growth again. That really hasn't happened. I'm going to start off by talking about the UK economy, which isn't something I generally tend to focus on, but I think it's a very good barometer for everything else that's happening in the world. And I think that one of the reasons why is that maybe the UK economy is perhaps more open, more transparent, and perhaps a bit less manipulated than some of the other economies that we can see out there. Certainly China isn't open, it isn't transparent, and it's definitely manipulated. Japan absolutely is not an open economy, we know that. The States is able to avoid transparency because it's able to hide behind its status as the global reserve currency. So that enables all sorts of games to be played there. And as for the Eurozone, well, the single currency is such a fog, such a miasma, that it just hides everything that goes on behind it. I don't think anybody would really claim to know or to understand anything that's happening in the Eurozone right now. So if we start off by looking at the UK, say purely as a barometer for where the world is at. The UK now appears to be headed into a triple dip recession. Everybody talked about a double dip. Well, they got there. They now seem to be heading back into a triple dip recession. And it also looks like it's heading for credit downgrade. It seems inevitable that UK is going to lose AAA status. Credit rating agencies have got the UK in their sights. For us, it's simply a matter of time. the UK, it's basically reached the paradox where debt levels are so high that they're impeding growth. If so much of what you produce is spent on either repaying debt or servicing interest on debt, then that prevents you investing it in a way that's going to generate growth. So we have a problem with the UK that it needs to do something about the debt that it's got. But the difficulty is that to do that, to repay debt, to deleverage, is something that also goes and takes away growth. If you accelerate your repayment program, again, you're using capital on repaying debt rather than investing it in future growth. So the UK basically has reached the horns of the dilemma, and the pretty sharp horns, that it really is struggling to go and borrow any further. It's so far in debt that that's restricting growth, and the deleveraging process is going to be very, very damaging to growth prospects going forwards. It's not only me that thinks so. I've got a quotation here. I'll read it out so it's word for word accurate. The UK is clearly at risk of being hit by a triple dip recession and could be heading towards a Japanese-style lost decade, with no guarantee that the economy will be able to return to the growth rates of the past. Now, they're fairly alarming words, and I think what's probably more alarming is that they come from the UK government itself. That's from Vince Cable, who's the business secretary, and those thoughts were also echoed by George Osborne, who's the Chancellor of the Exchequer as well. And I guess we shouldn't be too shocked that they said that, because anybody who saw the high streets in the UK around Christmas time, there were 50% discounts in Hobbs department stores, 60% at Bennett's, French Connection, Gap. All the retailers were slashing prices, not post-Christmas in the traditional sales season, but they were actually doing it in the run-up to Christmas this year, which is unprecedented, which is just a sign of how badly the high street's struggling in the UK. So the real economy is clearly facing an awful lot of headwinds in the UK. And the reason for that is whatever we may have seen, whatever positive messages we may have read recently, I don't think the big picture's actually changed at all. If we look at UK debt to GDP, you can see it's actually getting worse. There are some projections, I think, from the government, from the OBR, that maybe things might improve slightly in the coming year, but that's only because they're banking on being able to raise something more than £3.5 billion from selling off 4G telephone licenses, and that's going to be a one-time receipt. It's far from certain that's going to happen, but they desperately need it to. The UK, unless it has some bumper payday on the 4G auctions, is really heading into a crisis. So a lot of people say, you know, this time's different. Maybe we don't need to worry about debt to GDP as much as we have in the past, but if it is different, and apparently those are the most dangerous 4 words that have ever been issued in any kind of financial or economic discussion, that more dollars have been lost because of this time is different than they have at the barrel of a gun, apparently. But if this time is different, it's because it's much worse. If we look there, the average recovery, the brown line on top, that's what normally happens. That's what should have happened in the second part of the of this last 5 years, but it didn't. The current recovery is that fairly anemic looking blue line. So growth has been very, very slow. In the 6 recoveries that took place between 1948 and 1981 in the States, it took about 6 months, virtually like clockwork, every single time to return to peak productivity. That doesn't seem to have happened the last 3 times. In 1990, it took 15 months instead of 6. In 2001, it took over 3 years. Currently, we're 5 years into this, and we're nowhere near returning to peak levels. This is something extraordinary. The global economy, the US economy, the UK economy, it's not functioning. It's difficult to see what can happen from here that's going to improve that without any kind of major reset or any kind of major structural change. We certainly can't cut interest rates anymore. Interest rates are pretty well down to the lowest levels they possibly can be, so that tool's been taken away. We've been doing QE now since the end of 2008, and I think it's not only people like myself who are questioning just how efficient QE is. We actually see now that if you read the Federal Reserve minutes, then the Federal Reserve itself is starting to question that. There used to be two camps in the Federal Reserve. There was Ben Bernanke, the chairman, and his acolytes, who basically believed that QE was the answer, it was the panacea, and there were some small dissenting voices. Well, what's happened now is, I think there are three splinter groups. The dissenting voices have got a lot bigger. There are a lot of people who did believe that QE was the answer, who are now starting to question whether it's actually working at all, because in terms of economic output, it's really not having the effect that you might expect. And there's a very small group that's left gathered around Chairman Bernanke who still think that QE is the only answer. A lot of people talk about a jobless recovery. I think actually, we can see from there that employment levels are well below the peak. They're back to where they were 12 years ago. But it's not just a jobless recovery. This is actually a growthless recovery. We're not seeing any growth, and that's why we're not seeing employment return. In a sense, it's like when you've applied for every single credit card that you can and you've got them all maxed out, well, where do you go to next for credit? And we're getting into that kind of a situation. The CBO, the Congressional Budget Office, last year forecasted that over the next 10 years, US debt would rise by just under $9 trillion if a whole bunch of tax increases weren't put in place and a whole bunch of spending cuts weren't put in place. Well, we all know what happened. I mean, we didn't go off the fiscal cliff. We had some tax increases, we had some spending cuts, but the effect of those is probably less than $1 trillion, significantly less than $1 trillion. So we've had all of this furor, all this media attention, and so far all we've done is really deal with $1 trillion out of a potential $8 trillion deficit, increase in deficit. I guess one way that we've always tended to look at the States and to look at all the economies that have been resorting to QE is to look at what level of output, what have they generated by printing all this money. If you're a business and you go and borrow money, you'd expect to make a higher profit, a greater profit than the amount of money that you borrow. In the States, if we look at the increase in debt and in future obligations, last year that was around $7 trillion. $1 trillion of it was visible, and around $6 trillion was future obligations on entitlements, Social Security, pension. At the same time, the GDP only increased by around $300 million. So basically there's a 21% greater increase in US debt and obligations than there was in the amount of extra GDP that was generated. If you ran a business like that, pretty quickly you'd be foreclosed. And I think we're getting to the stage where we're getting close to the sovereign equivalent of that happening in America. Another metric to look at is that GDP, if you take away government spending, in 2001 it was $9.3 trillion. Last year it was $9.7 trillion. It's hardly changed at all. In fact, it'd actually take about 170 years at that rate of growth for US GDP to double. US GDP actually doubled twice between 1929 and 1988, so for it to take 170 years just to double once is again an alarming sign. And it's not just America or the UK that we're worried about. We think the problems are pretty well global. We've consistently said we don't believe Chinese government figures, although before the Chinese get too upset about that, we probably don't believe too many government figures of any governments. But the world's second largest economy always manages to produce its GDP figures quicker than anywhere else, and it's the only economy that never revises them. So we're perhaps even more skeptical about Chinese data than we are anywhere else. As far as we're concerned, China's a broken model. We've given everybody today a copy of a research report that we put out last year called Broken China's Turning Japanese. And for us, we think China is on the cusp of, we know it's 1, 2, 3 lost decades because of the fact that it's committing all the same economic sins, all the same economic crimes that Japan committed in the late 1980s. It's going for growth at any price. There's no organic growth coming out of China. All the growth is basically government-sponsored initiatives that are leading to fixed asset formation. They're building empty cities, untenanted retail malls, bridges to nowhere, all the same things that we saw happen in Japan, all the same malinvestment. And I think that's probably one of the biggest global concerns we've got right now. There's a dependency rate of 6 to 1 in China right now, which is the issue that they're trying to rebalance the economy. They're trying to get to domestic consumption, but they're not there yet. And for China to maintain 7.5% growth, which is a level that everybody seems to have settled at as being fairly comfortable, for it to maintain that for the next 5 years, it actually means real growth, organic growth, genuine economic activity, as opposed to fixed asset formation sponsored by the government, needs to grow at 20% a year. And there's just no signs of it growing at all. It's just not happening. So China is basically a conundrum. It doesn't add up, and eventually that's going to become obvious. If we move across Northern Asia to Japan, there's a whole bunch of euphoria in Japan right now because Shinzo Abe won an election and turned around and told everybody that he was going to create inflation, he was going to devalue the yen, and so far people seem to be believing him. We're not quite sure why, because Japan is in recession. It's had 2 negative growth quarters. It shrank by almost 1% in Q3 of 2012 alone. Okay, that was pre-Shinzo Abe, but we just don't think that turning around and spouting rhetoric is going to make a great deal of difference, and we don't see how you can go and implement the kind of policies that he's targeting without causing a whole bunch of risk and a whole bunch of consequences that will almost certainly mean Japan will have another prime minister within the next year or two, and it'll revert back to previous policy. Another economy which, again, we use the UK as a barometer. Another economy which we think is worth looking at as a barometer that's very interesting is Greece. In many ways, Greece is perhaps the single most important economy in Europe right now, because whatever happens to Greece, tiny and all as it is almost certainly what happens to the euro. We believe it's impossible for Greece to leave the euro and the euro to survive. Any crack at all in the euro is going to lead to a flood of exits. And so whether it's Greece, or it could be Spain, it could be Italy, any one country that leaves the euro is basically going to start a chain reaction that inevitably won't stop until we get to France. The only euro that will be left will be a Teutonic euro, because they're the only economies that would be able to withstand competition from a lower currency base from outside. Sorry, excuse me. Everything seemed to turn around in Europe last year when our man there, Super Mario, turned around and said that he was going to do whatever it took to save the euro. He didn't actually explain what that was, and since then he hasn't actually done anything. But they're obviously powerful words because they had a very powerful impact at the time. Unfortunately, they haven't had any impact on the high street, because if you go to Spain, if you go to Italy, if you go to Greece, you see that things are even worse than in the UK. We've actually got Greece and Spain vying month by month to set new record unemployment levels in Europe. We've never seen anywhere that had 1 out of every 4 of its population, its working population, unemployed before. Well, now we've got that in Greece, we've got that in Spain, and it's trending ever higher all the time. Spanish banks are an accident that's just waiting to happen. We're seeing record levels of default. Almost 1 in 6 Spanish loans are in default right now, and trending higher all the time. It's very, very difficult to see how the banking system in Spain is going to survive. it's very difficult to see how the economy in Spain is going to perform until that issue is addressed. The amount of doubtful debt in Spain is actually growing at 5 billion euros every single month. The ECB might try and throw money at that for a while, but it's very difficult to see what they can do about it. In Italy, we've got debt to GDP that's now, since then, pushed on to closer to 125%. We believe it's going to grow up to 135% by next year. The economic, the sovereign, the banking crises in Europe are totally unsolved, whatever Super Mario may have said. So it's very, very difficult to see how we're going to get through the next year or two without Europe creating some kind of economic catastrophe that's likely to resonate around the world. Not only do we have the threat of the single currency in euro, we've got geopolitical issues in places like the Middle East. There are an awful lot of tensions there that, with the inflation, with all the problems that created the Arab Spring, with the unemployment levels in the Middle East, aren't likely to go away in a hurry. And it's very likely that we might see Israel and Iran having a major confrontation over nuclear proliferation this year, which is a major concern. So globally, we're pretty uncomfortable. And a lot of it really is down to this single cause. We are drowning in debt. The problems with debt are that you have to pay it back, you have to pay interest on it, and you might end up having to pay it back at the time that's least convenient. One of the things that's perhaps misunderstood about debt is that the main purpose for debt, the main reason why people borrow, is what economists call intertemporal dislocation, or what you and me would basically call having today what we want to pay for tomorrow. And the difficulty with that is once debt gets to levels that are beyond what might normally be regarded as controllable, then not only does it affect our ability today to go and buy and to consume, because we're already so far in debt from what we had last year, but it also starts to stretch out and paint a pretty bleak picture of the future. So I would contend that there's very little that is likely to be positive or supportive for global economic growth until and unless all the problems of a world that's drowning in debt actually start to go away. I guess some examples of this. There's some corporate debt out there right now that actually is cheaper, it yields less than sovereign debt, i.e. some companies appear to be safer than some governments. And we're not just talking about governments like Greece, we're also talking about the fact that at one stage McDonald's Corporation was regarded as being more creditworthy than the United States if you looked at the debt yield and the CDS spread. The second thing, I suppose, is that the yield on the S&P is now coming in line with debt spreads as well, and again that's a sign to us that there's just way too much debt out there. We've heard some talk recently about housing recovery in America. I don't believe that story for 1 minute, because the FHA, the Federal Housing Administration, is basically now the biggest bank in America. There are so many defaulted mortgages in the States that haven't been enforced yet. Unless we see a strong and sustained recovery in housing prices and a strong and sustained recovery in personal incomes, then it's very difficult to see how the States is going to recover at all, and how the housing sector is going to recover. I mentioned earlier that the US has got a whole bunch of problems lined up for the future. It's not just got problems today. If you had to treat the US government as though it were a corporation, if you made it account according to GAAP rules, then it doesn't actually have a debt of 16 trillion, it has a debt of about 86 trillion. And as I say, instead of growing by about $1 trillion a year, it's actually growing by more like 7 or 8. So there is a scale of debt that we've never really had to encounter before. It's very difficult to see how this game plays out, one thing we're pretty sure of is all the promises that have been made to 315 million American nationals by the government are going to have to get broken in some way or another. People aren't going to get the entitlements that they're expecting. But we also see the unraveling of that whole process as being something that's very challenging for the American economy and very challenging for the global economy. We're already starting to see what we call fiscal consolidation. We're starting to see some deleveraging. We're starting to see that people can't get any further in debt. They've reached the peak. They need to try and get primary budgets to balance. We're not actually really seeing that yet, but they're trying to. And this is going to have a pretty brutal effect on GDP going forwards. It's going to take a massive amount of money out of the global economy. So, as I said at the start, we have this choice between borrowing more, making the situation worse, or between having to pay it back and the consequences of that. Well, I don't think we have that choice anymore. I think we are starting to look at paying it back, and we are going to be faced with the consequences. It's inevitable. It's where we had to get to, but it's going to be a fairly painful adjustment. And I think we all have to live through the belt tightening and all the cutbacks, all the decreases. And yet, I read a piece of research the other day that said even if the G7 economies basically do their best to de-lever, if they adopt austerity, if they do everything they can to cut the debt levels, it's probably going to take something like 20 years before we're back at levels of indebtedness that are conducive to growth. A fund manager called Jamil Baz from GLG made the comment that if you think that the crisis that we've had for the last few years was caused by leverage, the bad news is it hasn't even started yet. The process of deleveraging will have a negative impact on the economy because of the multiplier effect. Every dollar that governments take out of the economy is probably going to have something like $1.50 of impact. It means that Japan would probably need to reduce its debt to GDP ratio by something like 15% a year, so Japan seems inevitably committed to yet another lost decade. There's a Polish economist called Michael Kalecki who came up with an equation that profits are the sum of investments and the change in leverage. So if we do see deleveraging, it's going to have a massive impact on a negative impact on corporate profits. Again, just to go back to Jamil Baz, the deleveraging process could last 4 to 5 years in Europe, 7 years in Japan, and much longer in the States. And it will almost certainly result in a default of sorts, given that 10 out of the 15 OECD countries are on a completely unsustainable course. Italy, Spain, Japan, and according to Baz, the US will have to default one way or another. And he summed it up with the phrase, the Lehman Brothers saga was seen like a walk in the park. Debt's a real problem, but it's not the only problem. Demographics is a problem as well. If we look at it, even in countries like Germany, in Germany the 39 to 59 demographic, which is the main contributor to economic growth, is falling. It's fallen from just under 40% to just over 25% in the last few years. In Japan, we now have a situation where adult diaper sales are exceeding children's diaper sales, babies' diaper sales for the first time ever. It's a scary thought, not just a scary picture. As well as demographic problems, we also have wealth dispersion problems. Global wealth is not being distributed in a way that's conducive to growth. It's going to far too narrow a group of people and corporations, which means it's not being invested productively, it's not being spent, it's not leading to consumption. There are roughly 127 million people in the States who receive government transfers or some kind of benefit. There's 61 million people on Social Security and 66 million people who receive welfare. There's only 115 million full-time jobs in the States, so the amount of people on welfare now exceeds the amount of people in full-time employment. At the bottom end of the US socioeconomic spectrum, people are poorer now than they were 20 years ago. People who haven't got access to significant unearned income are seeing their real incomes drop substantially. Real household income in the States has dropped by almost 10% in the last 12 years. Basically, the spare disposable cash that people have has pretty much disappeared for most Americans. Net worth has also fallen. American households are now, according to some metrics, at a 43-year low in terms of their net worth. What they have in the bank, the value of their houses less their mortgages, is at a 43-year low. I suppose one of the big disappointments of the last few years was that we all were hoping that the internet was going to be a massive game changer for us in terms of productivity, in terms of generating income, generating wealth, generating profits, but it doesn't seem to have done that. During the period of the internet, we've seen, as I say, American net worth fall, we've seen incomes fall. So what could possibly have gone wrong? Well, maybe one reason is that the internet is not the productive tool that we thought it was. According to the Financial Times, every day the world spends 300 million minutes playing Angry Birds. Millions more are spent looking at videos of puppies or kittens on YouTube. There's 700 billion minutes a month spent on Facebook, and 2.9 billion hours per month on YouTube. So where does that leave us? Well, in terms of how to invest, for people who are concerned about capital preservation, one thing we do is we would avoid corporate bonds for starters. The valuation gap between corporate bonds and equities has got so bad that companies are now desperately issuing debt left, right and centre just so they can go and buy back their own shares, particularly in Europe. And that's obviously a sign that the companies don't believe that these are good times to be buying corporate bonds if they're selling them so aggressively. Does that mean there's value in equities? Well, not necessarily. It's not a binary game. The fact that corporate bonds are bad doesn't mean that corporate equities are good. In fact, as a friend of mine, Tim Price, who writes a newsletter, put, it's saying, I'd like to go and roll around in dog crap because I don't want to roll around in horse crap. It's this is not a binary decision. There are other alternatives out there. Sovereign debt, for instance, we think is a reasonably safe place to still stay parked right now. We don't think that the outlook for sovereign debt is that attractive, with yields of between 1% and 3%. But we do think that you never get a sovereign debt nominal bust. You don't see sovereign debt collapse by 10, 15, 20, 30, 40%. It just never happens. It may well depreciate slowly over a long period of time, but at least it's a reasonably safe place to be parked right now. We think there are some equities that are maybe interesting, particularly in Asia, particularly dividend-paying companies are perhaps a reasonable place to look. We generally avoid most equities, and that's not just because of the fact that high-frequency trading means that the average length that a stock is held in the US market these days is less than 22 seconds apparently. It's more to do with the fundamental outlook for equities. So I'd be very cautious about equities. I think as far as we're concerned, investors who are interested in preserving capital should be concerned by all the risks that are out there in the global economy. They ought to be looking at lower risk assets. They ought to be trying to find some sustainable yield. Prime property is still interesting, short-dated bonds, money market funds, and this is probably a pretty reasonable time to be holding cash, waiting for positions to get worse, waiting for situations to get worse, and waiting for asset values to fall dramatically and to go and buy in there. If economic data continues to disappoint or to deteriorate, then the more defensive position you have, the less you'll be hurt and the better your opportunities will be for the future. If the larger doses of liquidity that are being administered by central banks continue to look like they're going to kill the patient rather than cure it, then it's probably better to be safe than sorry. I think that's all I wanted to say, and I'd like Joe now maybe to come and put the counter argument.